Welcome to House Lux Estate, your guide to smart and sophisticated living. We're here to illuminate the path to financial resilience and wealth management. Our mission is to provide you with insights, tips, and strategies that can help you navigate the ever-changing landscape of personal finance and investment. Today, we're delving into a topic that's vital for every investor to understand: how to protect your wealth in a bear market. Bear markets can be intimidating, their growls echoing through your portfolio, but fear not. We're here to equip you with the knowledge and strategies needed to stand strong in the face of adversity. We'll explore how diversification, cash reserves, safe haven assets, and good old-fashioned patience can be your allies when the bears come knocking. So stay tuned to understand how to safeguard your assets when the market takes a downturn. Before diving into the strategies, let's first understand what a bear market is. Picture a grizzly bear, swiping its paws downwards. That's essentially what the market is doing in a bearish phase. It's a financial term used to describe a situation where securities prices fall 20% or more from recent highs. This decline can occur in any asset class: stocks, bonds, real estate, you name it. It's often accompanied by widespread pessimism and investor fears, only fueling the downward spiral. Markets are cyclical, with periods of growth known as bull markets, followed by bear markets. These cycles can last weeks, months, or even years. It's important to remember that bear markets are a natural part of the economic landscape. They're not something to fear, but rather something to anticipate and prepare for. Armed with this understanding, you can better prepare for the potential downturns in the market. The first strategy to protect your wealth in a bear market is diversification. So let's dive right into it. Diversification, in the simplest terms, is spreading your investments across a variety of assets to reduce your exposure to any one type. Think of it as a form of risk management. It's like having different types of fruit in your fruit bowl. If one type spoils, you still have others to enjoy. Now let's apply this to the financial world. When you diversify your portfolio, you're investing in a mix of asset classes, such as stocks, bonds, real estate, and commodities. Each asset class has its own risk and return characteristics, and they often perform differently under varying market conditions. Here's why this matters in a bear market. If all your investments are in one asset class, say stocks, and the stock market takes a nosedive, your entire portfolio suffers. But if you have a diversified portfolio, a slump in one asset class can be offset by gains in another. Diversification doesn't guarantee profits or protect against all losses, but it can help smooth out the bumps during bear markets and other periods of market volatility. It's about balance. Like a well-balanced meal, a well-balanced portfolio can help nourish your financial health. It's important to note that diversification isn't a one-size-fits-all strategy. Your ideal mix of investments depends on your individual financial goals, your time horizon for achieving them, and your tolerance for risk. You may want to seek professional advice to help determine the right diversification strategy for you. In addition, diversification isn't a set-it-and-forget-it strategy. Over time, market movements can shift your portfolio's balance, so it's important to regularly review and adjust your holdings as needed. In conclusion, diversification is a powerful tool for navigating bear markets. By spreading your investments across different asset classes, you can help reduce risk and potential losses. It's a strategy that echoes the old adage, "Don't put all your eggs in one basket." Remember, don't put all your eggs in one basket. Another key strategy is having a cash reserve. While this may seem like a basic principle, its importance during a bear market cannot be overstated. Let's delve into why having a cash reserve is essential in protecting your wealth during these trying times. A cash reserve, also known as an emergency fund, is a stash of money set aside to cover the financial surprises life throws your way. These unexpected events can be stressful and costly. Now imagine if these events occur during a bear market. The stress doubles, doesn't it? That's where a cash reserve comes in. It provides the financial stability you need, allowing you to weather the storm without panicking or making hasty decisions. But the importance of having a cash reserve extends beyond just providing a safety net. It also offers opportunities. You see, a bear market, while it may seem scary, is also a time of opportunity. It's a chance to buy assets at lower prices, a silver lining, if you will. However, to seize these opportunities, you need to have the funds readily available. Think of it this way. In a bear market, many investors are selling off their assets, causing prices to drop. This is where your cash reserve comes into play. With a solid cash reserve, you can swoop in and buy these assets at a discount. When the market eventually recovers, and it always does, you stand to make a significant profit from these investments. So how much cash reserve should you have? Well, financial experts recommend having between 3 to 6 months worth of living expenses saved up. But this can vary depending on your financial situation, lifestyle, and risk tolerance. Remember, building a cash reserve isn't something you do overnight. It requires discipline, planning, and a commitment to saving regularly. But the benefits it offers, especially during a bear market, are well worth the effort. In conclusion, maintaining a cash reserve is crucial not only for financial stability during a bear market, but also for capitalizing on the opportunities it presents. As the old saying goes, cash is king, especially in a bear market. Let's now turn our attention to safe haven assets. Picture this. You're on a ship in the middle of the sea and a storm hits. What do you seek? Shelter, right? In the world of investments, safe haven assets are that shelter. They're the financial umbrella you can open when the economic storm comes. So, what exactly are safe haven assets? They're investments that are expected to retain or increase in value during times of market turbulence. When the bears are running the market, these assets either hold steady or, sometimes, even rise in price. Think of them as the superheroes of your portfolio, providing a buffer against losses when things get tough. They're not designed to make you rich overnight, but what they lack in razzle-dazzle, they make up for in stability and resilience. Now, you might be wondering, what qualifies as a safe haven asset? Well, gold is the classic example. It's been a symbol of wealth for centuries and is often seen as a hedge against inflation and currency fluctuations. When the market's in turmoil, investors often flock to gold, driving its price up. Government bonds are another safe haven asset. These are essentially IOUs from a government promising to pay you back with interest. They're considered safe because they're backed by the full faith and credit of a government. They offer steady returns and are less likely to be affected by market volatility. And then, there are certain types of stocks. Not all stocks, mind you, but those in industries that provide essential goods and services. Think utilities, healthcare, and consumer staples. These sectors tend to weather economic downturns better because, let's face it, people still need electricity, medicine, and toilet paper, bear market or not. In the end, safe haven assets aren't about chasing the highest returns. They're about protecting what you've got. They're about financial prudence and risk management. They're about sailing through the storm, not outrunning it. Safe haven assets can provide a shield for your wealth during turbulent market conditions. Patience is a virtue, especially in a bear market. Like a skillful sailor navigating rough seas, an investor too must learn to weather the storm. Bear markets, by their very nature, are temporary. They come and go, but the investors who remain patient, who resist the urge to panic sell, are the ones who ultimately come out on top. You see, panic selling can lead to significant losses. It's a knee-jerk reaction, a response to fear, not logic. And fear, as we all know, is a poor advisor. In contrast, patience allows you to ride out the temporary downturns and benefit from the eventual upturns. It gives you the advantage of time, allowing your investments to recover and even grow. So remember, when the market starts to growl, don't let fear take the wheel. Instead, trust in the power of patience. Stay patient, stay calm, and you'll weather the storm. As we wrap up, remember these strategies to protect your wealth in a bear market. We've learned that diversification is not just about having different investments, but about balancing them in a way that reflects our risk tolerance and financial goals. We've also discussed the importance of maintaining a cash reserve as a safety net and a means to take advantage of market opportunities as they arise. We explored the role of safe haven assets, those stable investments that can weather the storm of a bear market, providing a sense of security in turbulent times. And finally, we underscored the power of patience, reminding ourselves that markets are cyclical and that downturns are often followed by periods of growth. So, whether you're a seasoned investor or just getting started, these strategies can help safeguard your wealth and position you well for the future. Thanks for watching. Don't forget to subscribe to House Lux Estate for more wealth and investment tips. Remember, smart living is all about making informed decisions.